So what if I told you that saving £8,121 could just be the turning point in your finances? It may seem like a strange, oddly specific number, but there's a very specific reason behind it. And today I'm going to share with you guys 5 ways that this number changed everything for me, and why it might just do the same for you too. So be sure to stick around because what you're about to learn could just reshape your financial future. We all have our own relationship with money and kind of how it makes us feel, but the reality is not many people have a very good relationship with it. According to the Money and Pension Service, 14 million people in the UK have less than £100 in savings, which is quite the shocking statistic. And this study also shows that 81% of people completely avoid talking about their finances. It's not helped on by the fact that we're not educated on any of this stuff, and I guess as a byproduct, there are millions of people here in the UK that struggle with personal finance and money management. And with that comes an increased level of anxiety too, with 32% of UK adults feeling anxious about paying their bills. And this is why, in my opinion, it's so super important that people have kind of a target savings rate, or perhaps a target savings figure that they want to achieve in order to reduce that level of financial anxiety. It actually flips the script a little bit on finances being somewhat of a stressful element of your life, and it actually can become quite a positive thing. Because a research report from the Personal Finance Centre at Bristol University stated that there is a positive relationship between savings and your well-being, which is where the figure of £8,121 comes into play. Well, kind of anyway, let me explain. I looked at some data collected by Nimblefins, which was from the Office of National Statistics, and it stated that the average running cost for a UK household is £2,707. Now, assuming that you are a 2-person household and you both contribute evenly towards the running costs on that household, I worked that out to be you guys contributing £1,353.50 each. If you then multiply that number by 6, you then unlock a level of financial peace of mind, also known as a 6-month emergency fund, which works out to be £8,121. Now, of course, this is just an average, a guide, if nothing else at all, because everybody's monthly expenditure will, of course, differ. So because of that, I've left a link down in the description below to an emergency fund calculator, which you can use in order to calculate what that 6-month emergency fund figure is for you. For some of you, it'll be a little bit less, some of you a little bit more, but for me, once I achieved that 6-month emergency fund figure, that kind of unlocked a level of financial peace of mind that certainly can't be replaced. But it doesn't stop there, because I've always tried to go beyond it, because it unlocks like a level of new financial mindset, which I'm going to talk about in point number 2. The psychology of money is such a complex topic, so much so that someone's written a whole book on it, which is on my bookshelf somewhere here, so I probably won't do it justice in the next couple of minutes. But one thing that I can certainly reflect on, especially during my late teens and early to even mid-20s, was that I was kind of always in the mindset of financial scarcity. And even, to be honest, now, sometimes I can still find myself in that place. Like, have you ever gone to buy something and thought, like, can I actually afford to buy that thing? Or that kind of inner financial guilt that kicks in where you're thinking, like, should I actually go to that coffee shop and go and buy my favorite latte? Or should I just wait until I get home and actually have one for the fraction of the price? I've been in that place in my own life, which some may say is a little bit financially frugal, or others may say it's actually financially responsible, especially if you don't have loads of money to go around. But for me, I'm also kind of the belief that it does also strip the kind of smaller pleasures out of life that are largely inexpensive. And having the right financial foundations in place, as we've discussed, from having an emergency fund, allows you to kind of switch that financial mindset from can I to I can. Like, you can afford that coffee whilst you're out shopping. You can afford that summer holiday this year. You can afford those Christmas presents without loading up on loads of credit card debt this winter. Once you have that level of financial peace of mind, that kind of scarcity mindset shifts towards a little bit more of a balanced financial mindset. It may on occasion still feel like a bit of a pendulum swinging within your own mind, where on some months you may feel a little bit more flush, and on other months you might feel a little bit more tight because perhaps you've had a big one-off expense like a car insurance payment that's gone out, or I don't know, a broken utility item that you've had to replace. However, once you've got into the routine of sensibly saving a percentage of your income every single month, that volatility of that pendulum swing shouldn't feel quite as much. It's certainly a mindset that I had to work hard towards, but it only came from having the right financial foundations in place first. And once you've built those right foundations, you can then take it that one step further. So let's talk about that next. I don't know about you guys, but I've always found the more money that I save, the kind of easier it becomes to save even more. And I don't know if it's because I'm kind of getting a decent interest rate right now on kind of my savings accounts, and there are lots of good savings accounts that are out there right now. If I just flash up a screenshot of Money Saving Expert, who are showing some top cash ISAs that are paying rates above 5%. Now, let's hypothetically say that you did have a savings account that was paying a 5% interest rate on an emergency fund balance of £8,121. That would be the equivalent to £33.84 per month in interest payments. It's money that you haven't had to earn, and it's almost like a little bit of a bonus payment for having some savings put to one side. Now, it's not always been like this, but the reason why it's like it right now is because the Bank of England currently has a base rate of 5% as at the time of recording this video. But these savings rate may fluctuate as the Bank of England changes its base rate over time. And actually, we've got an upcoming Monetary Policy Committee meeting, which will have taken place by the time this video goes out. So interest rates may have stayed the same at 5%, or indeed they could have been cut by potentially 25 basis points. Obviously, if we do see a Bank of England rate cut, then that could negatively affect some of these saving products that are out on the market. But nonetheless, savings rates across the board will still be quite high. So you might as well make the most of these interest rates whilst they're kind of historically high, or at least in comparison to the previous 10 years or so. And I'd like to stress the importance of this because I recently read an article from AJ Bell that said there is £253 billion in cash sitting in bank accounts that are paying no interest at all. At a 5% interest rate, that's £12.65 billion of unclaimed interest, if you like, that people are literally just missing out on from having their cash parked in a bank account that's not generating them any interest. Don't be one of those people, and make sure that you've got your money working for you. After all, it's money that you haven't had to earn, so you might as well make the most of it. Now, all of this is about building financial momentum, and I kind of liken it to a snowball rolling down a hill. The more the snowball rolls, the bigger it gets and the faster it goes. And your finances very much work in the same way. So start to build that financial momentum, get the financial snowball rolling, and then you'll start to then be able to achieve some of the financial goals that you have. And all of this comes from having the right financial foundations, but once you have them, it then opens up financial opportunities that perhaps you wouldn't have otherwise had. One of those opportunities being what we're going to discuss next. Once you've built those right financial foundations, you can then look at other mechanisms in order to be able to build your wealth. Now, the only way I can describe this transition is it's like almost like being on the defense a little bit to begin with. Say you'd like down to 10 men in a football game and you're just trying to hold out for a draw. Whereas when the next game comes around, you've got your full squad ready to go. You go all out on the attack, going to secure those 3 points. It almost becomes like a really positive mental shift in your finances. And one of the ways that you can go on the attack, if you like, is to start investing. Now, it's okay to make that shift to attack, providing that you do so in a way that's kind of aligned to your overall risk tolerance and your investment objectives, because when you are investing, your capital is at risk. But from researching from this video, I actually found out that a lot of people, most people in fact, are still playing on the defense. Because a UK investment report from the Shepherd's family shows that about 12% of UK investors are using a stocks and shares ISA account, which suggests that just most people probably aren't investing. Now, for those of you guys who aren't aware what a stocks and shares ISA account is, well, it's a place where you can invest in different assets. So, for example, you can invest in stocks like Apple, commodities like gold, or even funds that mirror broader indexes like the S&P 500 or the FTSE 100. And the reason why I personally use a stocks and shares ISA account is, well, number one, it's tax-free, so it makes sense to do so. And number two is that you get a £20,000 limit every single tax year that you can deposit into the account. It means regardless of the capital gains that I may have made from increased stock prices, or regardless of the income that I've received as a result of dividends, I will not be liable to pay any tax from my stocks and shares ISA account. Now, the whole point of investing for me personally is to grow something called your real wealth, but in a controlled manner. It's a calculation of deducting your nominal investment returns from the inflation rate, and that's the rate of real wealth that you're growing your money at. Because remember, inflation erodes your purchasing power over time. So for me, I've used investing as a mechanism to combat this by investing for the long term. It's funny that most people are actually investors, they just don't realise that they are. The latest data that I could find from the ONS suggested 79% of Brits were actually participating in a workplace pension. And first off, I think that's great, and it's thanks to some of the positive government policy shifts that have recently taken place with like auto-enrolment into pension schemes. But the only difficulty with that is how few people understand, firstly, what they're investing in or what their pension fund manager is investing in on their behalf, and secondly, how much you actually need to contribute to your pension in order to achieve your retirement goals. According to research carried out by Wealth at Work, 49% of adults with a defined contribution pension said they didn't know what their pension was invested in, with nearly 1 in 3, about 29%, admitting that they didn't even know that their pension was invested. So I guess it's kind of hard to address point 2 if you're unaware of point 1. And everybody has different pension providers, but I suggest if you want to go and do a little bit more research, you can tend to typically look at something called a KID, which stands for a key information document, or sometimes it's called a key investor information document. I've got a SIP with Vanguard, which is a self-invested pension because I'm self-employed, and they have literally across every single fund, whether it's like pension specific or not, a key information document which shows kind of the fund objectives, the level of risk that you're taking from investing into that fund, and lots of other key details that you should probably know if you're investing your hard-earned money. I'm sure all pension providers must be able to provide these kind of documents so you know what you're investing in, so you can go and do a little bit more research. But if you are still unsure, of course, just go and consult with a professional if you need that kind of further support. However, the point I'm trying to get to here is once you've kind of established an emergency fund that feels comfortable for you, perhaps you're already contributing towards a workplace pension, perhaps you're already investing on the side, you're kind of doing all of the right things, so to speak, then one other consideration that you could make is making additional contributions to your pension. After all, pension contributions are taken from your salary before you pay income tax and national insurance, so it's kind of tax efficient, if you like, to make those pension contributions. How much you need to put into that pension obviously depends on your own personal circumstances and what your kind of goals are for retirement. I'll leave a link down in the description below to a pension retirement calculator where you can kind of plug all of your own numbers in and then figure out whether you're on track or whether you need to contribute slightly more to your pension to reach your retirement goals. So I do hope that you found that useful. If you did so, be sure to drop a like on the video, subscribe to the channel whilst you're over here. And as well, if you do want to see 6 more tips on money and life habits that I've adopted during my 20s, then be sure to check out that video next. That being said, I'll see you over in the next one.